Okay guys, let's go and let's start. Okay, as usual, we are going to start by importing our raw packages. NumPy, Pandas and Plotly for the data visualization part. After that, you will have to import your API that you are going to use in order to import the data. We are going to import data from Yahoo Finance. And we are going to use datem package in order to have our date in the right format. In order to calculate the daily returns, we are going to use the same formula as we have done during the previous chapter, which means 1 plus closing price with a rolling period of 1 day in order to get the daily returns. If you want to have the B daily return, you just have to use 2 days rolling period. The daily cumulative return will not be useful concerning what we are going to reach, but I just gave you this formula in order for you just as a reminder of how to calculate it. If you want to have a complete description of it, you can go in the previous chapter. You will have more information about this point, but essentially just in order to have a cumulative daily return, which means like you started with a certain amount in your portfolio and you have the final percentage at the end. Okay, let's start. Let's start by defining our start and end dates. Concerning last year data, we are going to choose between the 1st February 2019 and today's date, we are the 22nd July 2020 today, but we are going to choose the 22nd July 2019 concerning last year. Execute. Okay, in order to upload our data, we will do something which is very similar of the advanced level task, which means we're just going and copy and pasting this loop. And yeah, and if you remember well, in order to develop this loop, we did 3 steps. First, we set up the tickers to which we want to upload the data from. For instance, if you want the data from S&P, if you want the data for this year, you're just gonna have to add a comma and blah blah blah, and that will download the data automatically. After that, you will have to set up the length of the list. Essentially, like the length will come here and check out how many shares do we want, and after that you will run your loop between I and the length of the list. You will just print an informative line which is like, okay, from which tickers we are currently uploading the data. After that, you will create a variable, a data frame with the name of the tickers plus data 2019. You will download the data from Yahoo Finance. You have the start date, end date, your ticker name, and that will download the data automatically. You can also store your data in a CSV file. You have just to uncomment this line. I'm gonna keep it commented, but you can just uncomment, and at the end just like using I equal I plus 1, and that's gonna generate and upload your data automatically. Let's execute. Perfect. Similarly for 2020, between the 1st February 2020 and today's date, which is the 22nd February. After that, same process, tickers and the loop. The only difference is we are going to call this data frame data 2020 instead of data 2019. And yeah, let's execute. Okay, let's check out if our data are good. Okay, 3rd February 2020 until 22nd. Okay, the data look all correct, that makes sense. And concerning last year data, okay, 1st February 2019 and 22nd July 2019. Again, the data look correct. Perfect. We can go to the next step. On this next step, what we are going to do, we are going to, if you remember well what you have done just here, like right now we have imported the right data concerning the S&P 500. It's what we have. We have the data for 2019 and the data for this year, 2020. And we will be able to compare the market and the market situation last year and this year. Now that we have imported the data, we will calculate the daily return. Let's go. Let's calculate the daily return. Again, we are going to use the same list, the same loop that we have created concerning the challenge in the hardest level. What we have done in this loop, you can find more information and more explanation, but essentially we create the data frame lists. So we are going to use the data frame lists, and we are going to use a ticker name for each one of this list. These ticker names will only be used in order to create a variable on which will be stored the column returns and the column cumulative returns. This stickers is only used in order to create a variable with this name. Okay, again, the length of the list based on any data frame on which we want to add these two columns, and the number of tickers are gonna be updated the same way. We're setting I equal to 0, and once everything is done, we generating the loop from I to length, which means here length gonna be 2, which gonna be 1, because we have 0, 1, which means I gonna go from 0 to 1. Okay, the first line is printing which data frame is calculating the daily returns. We are going to calculate the daily returns and the cumulative return just by using the formula. And after that, we are going to generate a variable, for instance, concerning SPY data that's going to be called current year returns, and that in which will be stored the column returns, and current year's cum returns, on which will be stored the column cumulative returns. Because we are going to use these two, at least this variable, in order to plot our data. Let's go. Let's execute. Okay, and right now, once we have created our data, what we are going to do, we are just going to check out our data frame if the data have been updated. As you can see, we have the return and cumulative return, checking for the 2019. And also that makes sense that the first value is non-attributed, because you can't compare the first date of your data frame with the previous date, because you don't have any data. And what we are going to do here, in order to avoid non-attributed value, we are going to set up this value as 0 when we are going to draw our graphs, but that's going to be in a second time. And second point, what we are going to do here, in order to plot our data, we are going to use Plotly Figure Factory. If you want to know more about it, you have just to go on Google and tap Plotly Figure Factory bin, and you will find all the different information that you need concerning Plotly Figure Factory. Essentially, in order to draw this type of graphs, I really like this type of graph because you can display it through bins, and you can have different normal distribution, and you can compare it much more easily. In order to plot this type of graph, what you need to import Plotly Figure Factories, set up your X1, set up your histogram data and group labels. Group labels is going to be just the data that you're going to have at your right. And histogram data, you're going to be your data concerning X1 and X2, which means here in this case X1 is group 1 and blah blah blah. And once everything is done, you will just have to insert inside it your histogram data, your labels, and the size of your bin, and that's gonna plot it directly. You can just develop it by yourself and create much more complex data, but if you want to find out more about it, you can just Google it and you will find more information about Plotly Figure Factory. That's not something that you're gonna use often, that's why I didn't create a module on it, but if you want me to create a module on it, just let me know and I will create 2 videos on how to use Plotly Figure Factories and Plotly Express. But okay, let's go. Okay, so which means that for x1 what we are going to use is current year returns. If you plot this one, that's the variable that we have created in this line. If you plot it, you will see that in this variable we have the current year returns. And I added at the end fill NA, which means that what that's gonna make, if you use fill NA, you will fill your NA value by 0. And that's the only thing that we are doing here concerning x1, which means for x1 we'll have the date and the current year returns. x2, similarly, that's gonna be the previous year return. And now after that, if you remember well on Plotly, what they are explaining is once you have your x1 and x2, you will have to add your histogram data as a variable and your group labels as a variable. Concerning histogram data, we're going to have x1 and x2, and group labels, we're going to have current year and previous year. Yeah, and like, yeah, cy and py here, like in the name of the variable, is the ticker that we have set up just right here. Okay, let's go, and now we can displot the bin size that we are going to use in the first time. You can use 1%, you can use 0.05%, you can use 1.5. Let's use 1% and check out what's going to be the results. Yeah, as you can see here, you can notice two patterns if you look at the graph. First of all, we can see that this year, current year, or you can change it to COVID-19, for instance. COVID-19. Yeah, as you can see, since the COVID-19 started, you can see that the data are much more spread. Let's go back. Let's zoom out. Yeah, since the COVID-19 has started, as you can see, the data population is much more spread, which means that if you look at it, like in the worst day, you can make minus 10.94% since the COVID-19 has started, and in the best day, you can make 9% by investing in the S&P 500. Whilst in more stable periods, the max that you can make is 2%, and in the last year period, in the worst day, you have lost 2.5%. That's the first point that we can have from as an output of it. The first thing is the range is more important than 2019. And what does that mean? That means there is more volatility. Which means that can be, when you see more volatility, that means that can be interesting, for instance, to invest in indexes such as VIX, which is an index which is taking value. More you have volatility in the market, and more the VIX index is taking value. And if you look at it, you will see that in COVID-19 period, the VIX went from 20 USD until more than 80 USD. And that makes totally sense, because when you look at this graph, that's obvious that the volatility have exploded since the COVID-19 has started. The second point that we can make from this graph is that the data population have been skewed slightly to the right, which means that last year data was looking by this way, and this year data are looking, that's very rough, but essentially what does that mean? That on average this year you would make more money on the S&P 500 than last year if you just like invest it and let it go. Even if you have lost 10% in one day, you must have on average recovered much more based on the normal distribution, which is very interesting to see, because when you know that the market and the economy is going down because the industry is not working, the unemployment is very high. That will not make sense why the market is even better than last year. But we can understand it because the American Federal Bank, the Fed, have injected a lot of money in terms of quantitative easing in order to support the American industries, which means I bought some junk bond, in order to avoid a market which is going to collapse, because that can create kind of vicious circles. If the entire market is going, if let's say the S&P 500 starting going down, which means the companies has less money to invest in research and development and to hire people, which means they're gonna have to fire people, and more you're gonna have people who's gonna be fired, and less they're gonna buy goods, and less the economy gonna be down. I'm not going to make an economic class right here, but essentially it's interesting to see that since the COVID-19 have begun, on average the market is performing better, and that can be explained indirectly by the Federal Reserve, which is buying junk bonds through quantitative easing. If you want to know more about quantitative easing, you can just Google it and you will find very interesting articles about it. What is quantitative easing? Okay, that's in French, but you can find out more of this information on Google, and even the Wikipedia. Okay, let's say English. Yeah, you will find. Yeah, I believe the explanation Investopedia is very good about how the quantitative easing is working. Yeah, so to make a quick recap, two points that we can raise from the COVID-19 analysis is that, first of all, the market is much more volatile, and the standard deviation of the markets have raised massively. Standard deviation and the variation have raised massively. As you can see, that's pretty obvious that the normal distribution is much more spread, and the variance, because essentially the standard deviation is the square root of the variance. Up, you have your variance, and your standard deviation is just the square root of the variance, which means that the variance of the market has exploded. And the second point is that the market as well has, on average, been skewed to the right, which means that the average have been pushed slightly to the right, but that makes sense if we consider the quantitative easing policy from the American Federal Bank. I hope you enjoyed this analysis. I'm going to make a second video in another time in the next months about a more complex analysis of how COVID-19 have impacted the market. But I found that interesting to analyze how the normal distribution of the market have been impacted. And as a trader, what does that mean for us? That means that when you see that the market is going down, you should just cut your position, because that can go very, very down. But by another side, when you see the market is going high, you just have to push your money and put your money inside the market, because you can make a lot of money. So guys, thanks for watching this video, and see you in the next one.